really, in the face of so many things going against it. Gold's up 6% this year. Yeah. I mean, the stocks aren't, I know, but gold's held in there extremely well. So you can imagine when instead of being a huge headwind, it's an actual tailwind. I think it'll surprise people for what gold does. What people forget, and I'm very bullish on silver. I mean, the gold-silver ratio, the supply-demand, the solar. There's so many positives for the area. But what people do forget is if the price rises dramatically in a very short period of time, which I don't want to happen. I'd rather it just to be nice.
Upside looks more probable than downside for gold in the current environment. Several analysts and agencies forecast gold could rise above 10 to 15% or even more in 2023. Thompson is optimistic about silver long-term performance, expecting it to increase significantly over the coming years along with gold. Silver recent strength could be just the beginning, and the technical picture has turned bullish for both the gray metal and gold, according to analysts at ActionForex. This week, gold futures closed at $1,942.50, down $24.60 per ounce, or 1.25%. Gold stocks, as measured by the NYSE Arca Gold Miners Index, ended the week lower by 2.76%. The S&P or TSX Venture Index came in off 1.76%. The U.S. trade-weighted dollar rose 0.79%. Contrary to that, Thompson anticipates a bright future for gold stocks in the coming months and advises investors to focus on their long-term potential. Financial investor Rashad Hajiev recently tweeted, "Gold-to-silver ratio formed a false breakout at a 6-month continuation pattern and likely headed lower to test the lower band at 78. Once a key support level around 78 is broken, expect ratio to reach 62 and 63 level. So if gold goes to my $2,600 target, silver should reach $40 mark." Now, we are presenting you a glimpse of Bob Thompson's insights from his recent interview with Soar Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Happy with the gold price, unhappy with the stocks, but I think that's logical. I mean, when you raise interest rates dramatically, whether it's the Russell 2000 small cap index in the US or the TSX Venture, anything small cap where you have to take risk has been devastated. So it doesn't matter that the gold price is almost at an all-time high, the stocks are, but that creates a phenomenal opportunity, right? You know, Stanley Druckenmiller, the best money manager in history, once said, and I think this is very important for people in our industry, he said, forget everything that you see right now that's happening in the market or with the economy. Forget it all. He said, look ahead 18 months and envision to yourself, what's the world going to look like in 18 months? And that's what you invest in now. I think in 18 months, gold stocks are going to have done very, very, very well. So, you know, something that's important, we're all trying to time and figure out the bottoms and the tops. What you do is you say, gold stocks are extreme value right now. If you look at I look at the HUI, to gold, right? And that's around 8.5 right now. It peaked at 10 a few years ago, but it's hardly ever been over 9. So that tells you that gold stocks are very undervalued compared to the gold price. And take a position, hold it, don't look at the market every day, and let the market come to you, right? People don't do that. They figure they got to be in there doing something every day. Now, the market's just a place to trade, right? If it was a private company, you wouldn't worry about the price every day. And I think that's so important. Let the market come to you. And silver is funny. It's such a small industry, and it's so easy to push the price around, right? I mean, I'm a little disenchanted. Gold, silver, you know, other commodities, because the futures market was made for producers to lock in a particular price in the future, because obviously you want to know the price you're going to get for your commodity in the future so that you can plan your business accordingly. The futures market was not invented for manipulation and pushing the price all over the place. So it's in the futures market. I mean, but that's what happens, right? So yes, I look a lot at the commitment of traders report on a weekly basis, because unfortunately, banks, the bullion banks, never lose money, right? So if they're very, 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 very short, the price is going down. That's what's going to happen, right? Hedge funds, interesting enough for the dumb money, they load in at the top and short at the bottom. Don't know why. So I don't pay attention to them. I pay attention to the bullion banks. Bullion banks, we're kind of net long silver at the bottom, and silver rose up to a nice price here recently, and then unfortunately they've gone all short again. So now the price is going down again, right? So we have to be cognizant of how they're pushing around the price on a daily and weekly basis. But again, I don't think that matters in the midterm, because I think silver is going to rise fairly dramatically over the next few years, as well as other commodities, right? Now, I think that the demand obviously is great as long as the supply doesn't come out of nowhere, right?
During the interview, BobThompson explains that the mining clock provides insight into where the market stands in the commodity cycle. The yellow metal's latest behavior involves a bounce from the second retest of this line, hinting at the potential for an upward journey toward the macro resistance at $2,080. The broader pattern suggests a bullish sentiment, although market dynamics can always introduce unexpected twists. A recent report produced by the state shows that 4.6 million ounces of gold, 6.1 million ounces of silver, and 154.2 million pounds of copper were mined in Nevada in 2020. The only lithium mine operating in the U.S., the Silver Peak mine west of Tonopah, produced 6.9 million pounds of lithium compounds. Silver Peak produces about 1% of the world's lithium, with most of the supply from Chile, Argentina, and Australia. Let's get back to the interview.
I think that's why, something we've talked about a lot in the past is the mining clock.
Yeah.
And the mining clock kind of makes it a quantitative approach rather than qualitative. In other words, what's happening in the market tells you where you are in the cycle, because believe me, in commodities, you better be getting out when things are fantastic and you feel really good, because it's going to do the round trip again, right? We're nowhere near that euphoric stage in anything. But having said that, I was pounding the table 3 or 4 years ago, and a lot of people thought I was crazy, including money managers, about uranium, because it was at 4 o'clock in the mining clock, right? 4 o'clock is the time in which prices bottom. There's zero interest in the sector. Companies are taking projects offline. Companies are going bankrupt. Companies are reducing their cost if they're producers down to support the new price. And Cameco at that time was $10 US, right? And here we're at 40 US. So it's there's a 400% gain that has happened already. Now everybody's getting interested in uranium, and that's good. I think it's got a great run ahead of it. But you missed 400% already, right? If you're just getting interested in it now, right? And same with the juniors. So I think the mining clock is great to kind of look at and say what's happening in the markets, telling you when to get out. And we'll be talking in 3 or 4 years, and I'll be saying, or 5 years or whatever, and I'll be saying, Kai, everything the mining clock is telling us that we shouldn't be invested in these stocks anymore. 2 or 3 years ago, gold and silver were probably 7 o'clock. And at 7 o'clock, when prices are high, you start to get financings come in. You remember what happened in 2020, September of 2020. Lots of financings came in, and that's fine. That money goes into the ground, and then you start to make discoveries, right? There hasn't been a lot of great discoveries, but there's been some discoveries, Snowline, et cetera, that have happened over the past few years. Uranium, though, at the time was 4 o'clock. Right? No money was coming in the sector. Everybody hated it. Production was still going down, et cetera. So uranium's caught up now to gold and silver. We're probably at the same spot. Nothing euphoric. Copper is probably around the same spot too. We aren't getting falling prices in commodities. Copper's,
not the commodities.
They might have pulled back a little bit, but again, they're not at their lows, right? Gold, we're double where gold was in December 2015, right? Gold was at 1,050, but we're double that. And silver hit 14 or whatever, 12, I think it was, and we're at 23. So we're still in uptrends, right? And I talked to Eric Sprott frequently, and Eric said that to me recently. He said, everybody's concerned, but we're in an uptrend. There's higher highs and higher lows. That's a bull market. I know it doesn't feel like a bull market, but it's higher highs and higher lows as far as the commodity prices are concerned.
Gold jumped 1% on Friday, helped by a weaker dollar and safe haven buying after the United Auto Workers Union kicked off strikes at 3 automakers in Detroit, while hopes around a likely pause in U.S. interest rate hikes lent further support. Optimism surrounds silver long-term performance, with technical indicators turning bullish for both silver and gold. Given the positive sentiment and technical signals, the precious metals market seems poised for potential upside, particularly in gold. How might unexpected factors impact the projected bullish trend for gold and silver? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.